Inflation and interest rates. The two are closely linked. Here's how one influences the other. Inflation is the upward trend on prices for goods and services. When prices rise too quickly, it erodes the purchasing power of your dollar. That cuts into wages and savings. The Bank of Canada's main job is keeping the annual rate of inflation around 2%. It is currently running at around 7%. Inflation is caused by both supply and demand issues. Supply-side inflation happens when costs rise, leading businesses to increase prices. Think rising oil prices, wages, or transportation costs. Demand-side inflation happens when people want to buy more goods and services than the economy is able to produce.
Inflation is well above our target.
The Bank of Canada can't do much about supply shocks, but it can influence demand in the economy. It does this using interest rates. Interest rates are the cost of borrowing money. When money is cheap, people and businesses tend to borrow and spend more. This is particularly the case for big-ticket items such as houses, cars, and appliances.
Interest rates will be on a rising path.
If the economy is running hot and demand is outstripping supply, the Bank of Canada raises interest rates to slow down borrowing and spending activity. As a response, companies increase prices more slowly or even lower them to encourage demand. This reduces inflation. The opposite is true when the economy is slowing down. The central bank cuts interest rates to encourage borrowing and spending. The Bank of Canada did this at the start of the COVID-19 pandemic. In March 2020, it slashed its benchmark interest rate to near zero. That caused interest rates on mortgages and other types of loans to drop to record lows. The inflation we're experiencing today is caused to a significant extent by supply-side issues. COVID-19 shutdowns have interrupted global manufacturing and transportation networks. Droughts are pushing up food prices, and the war in Ukraine is pushing up oil and other commodities. Supply problems have been compounded by a dramatic shift in consumer spending, partly supported by pandemic relief checks from the federal government. Amid COVID-19 restrictions, people spent less on vacations and restaurants, and more on durable goods like electronics, furniture, and so on. That pushed up goods prices and added to transportation bottlenecks. Low interest rates over the past 2 years also encouraged Canadians to gorge on real estate, pushing up the price of housing. Today, the Bank of Canada is increasingly concerned about domestic sources of inflation, tied to a tight labor market and a rebound in the price of services. It is also worried that people will lose faith in the bank's 2% inflation target. If Canadians expect inflation to stay high, businesses will set higher prices, and employees will demand higher wages. That makes the central bank's job of wrestling inflation back down much harder.
And what you see in an economy when inflation expectations become unmoored is that nothing in the economy works well.
The Bank of Canada waited until the spring of 2022 to start raising interest rates, but now it's moving fast. Starting in March, it has increased its benchmark interest rate from 0.25% to 1.5%. That's just a quarter point below the pre-pandemic level. Bank officials say they will likely have to push the benchmark rate to around 3% or higher. Raising interest rates is a delicate task. Move too slowly, and inflation can spiral out of control. Move too fast, and you risk tripping the economy into a recession. The economy is particularly sensitive to higher borrowing costs because of how heavily indebted Canadian households are, especially with mortgage debt. If people need to spend more on monthly debt payments, they have less to spend on other goods and services. There are already signs that higher interest rates are having an effect. The housing market, which tends to be the most interest rate sensitive part of the economy, is slowing down. the number of home sales across the country fell 12.6% from March to April, and prices have begun to drop, particularly in the country's hottest housing markets. The Bank of Canada has a long road ahead. Inflation is expected to continue rising in the coming months, and the central bank does not expect inflation to return to 2% until 2024.